Hi, Hunter Hastings here. We look everywhere for signs of entrepreneurial value creation. And one place to look is in financial services and products that serve that part of B2B that we think of as the backbone of the economy and the government calls small and medium businesses. We're delighted today to have Dave Kotter with us. He's CEO of Integrity Capital, LLC. He's in Scottsdale, Arizona. He's a commercial real estate financial consultancy, and what he does is simplify, make it easier to finance both borrowing and lending. He's done this for over 2 decades at Integrity Capital, and he's facilitated over $2 billion in loans. He's a substantial player. He also hosts a podcast, Behind the Capital Curtain. So he pulls back the curtain on commercial real estate and business investments, and we'll do some of that today. He also runs a hybrid debt fund, helping RIAs, high net worth investors, and family offices build wealth through private investments. So we're going to explore with Dave innovative ways investors and developers and businesses can access capital, new lending products, and the future of debt innovation.
This is the Value Creators Podcast, your source for a new kind of business education, escaping from business administration mode and entering dynamic entrepreneurship mode. We're guided by entrepreneurial economics, which is the source of all growth and positive change for businesses of all sizes in all markets. We talk to experienced experts in value creation so that there's business learning for you in every episode.
Dave, welcome to the Value Creators Podcast.
Thank you so much for having me here. It's a pleasure.
Well, it's our pleasure. We're always looking for value creation in difficult places and looking for innovation and new ideas. You're the CEO of Integrity Capital. You've been there for over 20 years. And one of the things we like to do, Dave, is think about, we call it founder's intent. We believe that founders are special people, and their intent when starting the business is a spirit that drives it for a long, long time, no matter how big it gets. So tell us about your founder's intent and when you were founding Integrity Capital and any other background that'll help us proceed.
Yeah, it's always a fun experience because I've been spending more time reflecting on, when you're younger, what were you doing? And my dad he was a podiatrist. And one of the things he used to do was to give me medical kits. And he would say, Dave, here are the medical kits. Go sell them. Don't come back until they're sold. Mm-hmm. And so ever since I was a little kid, it was just embedded into me that you go out and you figure it out and you try to build something. And I think there was just always this insatiable appetite for creating things, for trying things, for building things. And that's just been in my DNA ever since I was a kid. We had lemonade stands, we shoveled sidewalks, I sold my mom's furniture one time, which by the way didn't go over very well. And then, had a landscaping company in high school that we sold and then moved down here. And so the original intent for Integrity Capital and eventually hybrid as it came to be was we just had a desire to build something that had tremendous value for the clients that we were going to work with. And, honestly, I think at the time we were just hungry to try to build something from nothing. And I think that was our original intent when we got into it. As we got into it, realized there's tremendous frustration within the industry when it comes to navigating the complexity of commercial real estate. So we really desire to create simplicity in a really complex world.
So we love that entrepreneurial leadership perspective, Dave. So what is value for your clients? Is it solving that complexity? Is reducing those frustrations? How do you think about value in that sense?
Yeah, I think there's a few elements of value creation when it comes to clients. The first one is the lack of the ability to have access to the capital. So when we sit back and we think about what are the engines of growth and value within our particular area and space of financing. The first one is just accessibility. People can walk into their local bank and it's fairly accessible, but it doesn't necessarily mean it's the best route to go. But that's just where you default. And so we really provide what I believe is accessibility to capital for people. The second component of that is proactiveness. It's thinking ahead 2 or 3 or 4 steps to identify what are the areas of landmines that could potentially take place for clients and really try to address those up front and shut those things off before they become a problem for them. And so I would say those are the two major areas that we try to identify, is really trying to be strategic in the way we structure things and then identify and foster remarkable relationships that can ultimately execute for the client as they're trying to facilitate and even, identify and raise the capital that they're trying to close on their buildings.
Yeah. So if you would, just let's drill down into those two things, the barriers and the landmines. Mm-hmm. So barriers, that's one of the things that we think about in organization a lot. How do you remove the barriers to what we call flow, and so the value creation can be frictionless? What are the access barriers that your customers face? Is it that they don't meet the qualifications, or they don't have the right network connections, or they don't know how to fill out a collateral form? What are the barriers?
Yeah, it's a great question. And I would say, to rewind a little bit on that, if you think about the two different worlds, you've got residential, which we don't do, and then you have commercial. In residential, you have, for the most part, it's pretty uniform. You got a house, got a townhouse, it's a single family residence. You're going to buy it, you're going to live in it. It's fairly seamless on the way they're able to do that. In commercial, there's some general frameworks for which you have some level of uniformity, but every single deal has a lot of nuances to it. Whether you're saying, well, I'm buying an apartment complex. Well, what type? Is it individually metered or master metered? How big are the units? What's the location? What are the demographics? I mean, there's so many things to think about. And so when it comes to the barriers as it pertains to this specific world and what we call accessibility, when you go into a commercial loan, that particular capital source could change within a 3 to 6 month period of their desire, of their underwriting, of their intent, of their management. And so a lot of it comes down to, number one, not even knowing where to go. Like if you try to go get a life insurance company loan, good luck. You don't even know where to begin, nor would they take your phone call. So just being able to know, like, I can go to a central source that can actually facilitate that is a really big value proposition. And then the second component of that really is being in a position to say, why are you choosing to go to this particular lender for this particular time? Well, it's because you have the data. It's because you have the information. You know where they stand right now, today, making that decision. So it's a real-time issue as opposed to just stagnant information. So I would say that's probably from an accessibility perspective.
Okay. And then on the landmine side, and when we think about covenants and loans, we think about changes in interest rates in the economy, we think about construction problems. What are the big landmines? Can you categorize them, or are they everything?
Oh, yeah. Well, I'll keep it pretty segmented here, but I would say the majors are going to be, first and foremost right now, valuation, of really understanding, how is this going to be valued? Have you communicated all the appropriate elements of this building for the appraiser to do his or her job? Because valuation will make or break the deal, period. If you don't have the valuation, you're not getting the loan to value you want to. If you don't have the loan to value, you're in trouble because you only raised X amount of equity. And so valuation's a big landmine that we spend a lot of time up front getting comps, having conversations, walking through those things and not ignoring that particular reality, especially in today's market when valuations are very much in flux. And then the second component of what we would consider a big landmine comes back to that person's projections and how much they really did the underwriting. Because what they believe is the appropriate vacancy factor or expense ratio may not be the same that the underwriter's going to do. So it's trying to match those two worlds together to say, let's address those factors up front so that we don't run into issues down the road. And then I would say the third one is just sponsorship. It's being able to address the sponsor's history, look at their financial viability, and assure that they're in a position to really be able to execute and sign on a loan where people are going to say, yeah, we like that sponsor.
Yeah. So valuation, that's an interesting word. And we always try to emphasize when we think about value creation as a topic that value is a verb. It's a process. It's a thing that's constantly changing. You try to project revenues into the future and discount them to the present and put that on the balance sheet as a valuation. But as you say, everything's changing all the time. We've just been through a big cycle of COVID and work from home, and the whole valuation of office buildings changed tremendously. So how do you deal with that? How do you project into the future when the future is so uncertain?
Well, if I knew the answer of the projection, I definitely wouldn't be where I'm at today. But I would say the first thing is you have to accept reality. You've got to go back to the basics of saying, look, what's going on in that particular sub-market, because real estate is a sub-market deal, period. It's not a national deal. It depends on from neighborhood to neighborhood. It could be very different. And so it's really getting granular to say, like, what's going on in that particular sub-market. And then also understanding that interest rates have such a huge factor because the person's cost of capital allows them to know how much cash flow they can get. And the cash flow is constrained. There's only so much cash flow you're going to get on that because, that's how much you can charge for rents. So a lot of it comes back to not only understanding those sub-market microdynamics, but furthermore than that, it's being able to think through how value is created from the appraiser's perspective, not just in looking at rental comps or sales comps, but being able to identify the additional things like, by the way, I'm across the street from a big box, and down the street, there's this employer that's going in, et cetera, et cetera. So you have to identify reality, but then you also have to identify what are the value driving factors. Well, I'm 2 miles from the I-80. All those things come into play when you're trying to make a decision.
So it sounds like it's hyper customized, hyper personalized, right? It's an individual loan, individual borrower, and I'm sure you can make generalizations and you've got formulas and so on like that, but it does sound like that's part of the value proposition, right? We understand this particular loan, this particular building, this particular developer. Is that right?
It is. There's no one size fits all in the granular sense. There is a framework that we follow in our own particular model that covers the 30,000 foot view. But our job really is to take our expertise. I always call it having a different pair of eyes. Wisdom really is that. When I walk into a room, I'm going to see something different because of all my gray hairs. I've had the experience to be able to say, I see something you don't because of the amount of experience I've seen on each one of these transactions. So we try to apply that to that particular situation. And then we try to elevate and highlight those things that we know the capital sources really, really care about, and then what they don't. Because people think, oh, everybody loves to hear about this. They probably don't. They want to hear about the things that matter most to them, and that's part of our job.
But that emphasizes a area that we like to spotlight, Dave, which is that a lot of business decisions are properly subjective, they're intuitive. As you say, you see something different because you've been around a long time versus what somebody else sees, and that's subjective. And it's good. That makes you a better businessman.
It does. Your experience, I always call it, having time under your belt, plus taking the time to reflect and iterate equals a formula that tends to work over time because you're cumulative. It's like they say 10,000 hours. Well, you could have 10,000 hours doing a lot of dumb things, but it's 10,000 hours with 10,000 iterations. That's when you can really add value through wisdom, I believe.
Yeah, yeah, learning some patterns. But just so we understand your business properly, you have a hybrid debt fund. Is that
Correct.
a new arm of your business? Is it a rename? Is it a hinge? Tell us about hybrid debt fund?
Yeah, hybrid debt fund came out a couple of years ago at one of our retreats with the intention and understanding that we said, if we're really, really going to add value and we're tremendously going to be able to be more proactive, then we need to be able to fund directly. And so that launched a totally separate arm, which is called Hybrid Debt Fund. And the impetus behind it is to provide niche products that can add value to clients and we can close with a lot more confidence. And so the product that we have through Hybrid Debt Fund is what we would call a stretch senior participating loan, where we're coming in and most people, they're going to go get a bank loan and it's 65%, then they have to go raise equity. Our loan goes up to 80, 85, 90%, sometimes higher. And we actually participate with the developer in the upside economics. So we'll take 30 to 35% of the profit participation of cash flow plus when they sell the project. Even though in that situation, we're not their partner, we are in a sense because we are higher on the stack and they don't have to raise as much equity. So it's a launched new fund. We do $5 to $15 million in size, and it is a private credit commercial real estate fund.
Yeah. So, as a non-finance guy, can I think of that when you say hybrid? It's a hybrid of debt and equity. It's
Yeah,
both those things.
it's the best of both worlds, I call it, because you get the security, especially from the investor perspective, of having a first deed of trust against a piece of real estate. So if there's ever an issue, you can actually foreclose. But you also get that ongoing, consistent current income. Plus, you get the upside benefit of the equity feel, where all of a sudden they're going to get cash flow. You get 30, 35% of that. Plus, when they go to sell, you get 30 to 35% of the upside. So to me, that's why we call it hybrid, because you get both debt and the equity pop.
And from what I read, you say you're supporting RIAs, high net worth investors, family offices, and that. What's the connection there? You've got the new product. How is it specific to those kinds of customers?
Yeah, you have a couple of distribution channels when you're raising equity. You're either going to ultra high net worth individuals, or family and friends. Second channel would be RIAs, which are your typical family, an office that has X amount of financial planners that have, $500 million to a couple billion of assets under management. And they're going to their clients and saying, look, you have this alternative investment you can go into for $100,000 or $250,000. And here's the return profile. Well, that's one of the channels that we help support and educate RIAs. And then we also have family offices, single or multi-family offices that also deploy, 10, 15, $20 million into a fund. And then obviously we just have pensions, et cetera, et cetera. So those are just different distribution channels that we serve.
Yeah. So that brings us to another word I wanted to have you elucidate on a little bit, Dave, was facilitation. So you talk about facilitating billions of dollars of loans or deals in your situation. And, I think we have an idea of facilitation as kind of a network of relationships. You've got the borrower and you've got the lender, and you've probably got lots of other components. Map that facilitation network for us in a deal that you can give us as an example.
Yeah, I mean, we've, a little while back had worked with a local, what we would call BTR or build to rent developer, where they're building a subdivision with homes with the intention of renting. And they were putting together probably somewhere between about $110 to $150 million worth of, projects. So they had 3 or 4 projects they were putting together and they were developing them. And so they needed to go out and get debt. And so again, they have choices to go back and try to talk to the banks. It's very challenging especially with that size.
Mhm.
So they engaged us at Integrity Capital for us to be able to come in and do a few things. First of all, we call ourselves advisory. It's to spend the time really understanding the projects, understanding the economics, understanding them, their objectives, what do they want to try to accomplish, and where are they at, and how much experience do they have. Once we've gone through that cycle ourselves of really understanding the project, the next step for us then is to really identify where is the best lane for them to go. You have a couple different options. You could go life insurance companies. That's an option. You could go CMBS, although they don't do construction, but that's for more permanent. You could go into the private world, which is the world I'm in, private credit, which is you have debt funds, and now there's thousands of them out there. Or you could go into the public institutions. So in this particular situation, we decided we were going to go the private route. The reason why was because for them, they wanted to get leverage. That was a really big deal for them. And they needed non-recourse. And those two buzzwords were critical when it come to facilitating a loan for
Mhm.
them. And we ended up getting them on a couple of the projects, 77 to 80% loan to cost, which is very high. And successfully were able to procure the loans for them. And they have been able to construct and stabilize and sell some of the projects. So it was a real big success.
We're delighted to announce the Value Creators online course. For entrepreneurs in every kind of business, big, small, or medium, at every stage, in every industry, our course provides the foundations and principles on which to build success. Simple, clear purpose and principles give rise to creativity, innovation, and competitively superior business action. There are 11 foundational principles or mental models that together cohere into the value business model. Principles for value generation, principles for value operations, principles for value finance and accounting, and principles for value sustainability, as well as the new knowledge accumulation you'll need for continuous innovation. These principles are delivered by top business professors from top business schools: Mark Packard, Peb Ireland, Gordon Miller, David Rapp, and Bart Vanderhagen. You'll find video lessons from them, along with downloadable tools, processes, and other valuable content. Master these lessons, and you'll master the most important skill in business: value creation. Go to thevaluecreators.com and click the course link. That's great. Congratulations. And I think about that as it's a relationship product. What you're doing is the values in these relationships. As you say, it's in your experience, you know where all the connections should be made. But the product, the interest rate and the debt and so on like that are pretty basic. But the relationships, what you've just described, that's pretty exotic and high value that you're bringing. Is that a good way?
Yeah, it is. The value is in the people. I mean, when you break down business, it's always, people, then you have strategy, then you have execution and capital. Those are the four elements, right? And the people is where we always start, because people in of themselves add value. And so internally we have the right people, and we go through a lot of process to make sure we do. And then externally, fostering those relationships and then making sure we're matching up with the right kinds of people at the end of the day. Because you could have someone who's the wrong person at the right company and they're going to just botch it. And then you could have somebody who's maybe not at a great company, who's a great person. And I've seen those people get it over the finish line. So it always comes back to the relationships and people.
Yeah. So what are the innovation trends? Dave, you've described a couple, your hybrid product, and you've described different pathways, but what are the innovation trends that are ongoing here, do you see?
Well, I would say a few things. I think anybody's putting their head in the sand if they don't, understand these two letters, AI. And, it's a revolution of how people are thinking and acting and operating. And so I think there's a couple of areas of innovation that we see. One is going to be creating a lot more underwriting efficiency with AI and making sure that that process becomes much more nimble, much quicker, and cutting out some of the red tape. I see that as a big area of innovation where you can now really get into the nuances, and AI can capture a lot of that information quicker and also cut out some of the red tape and the fat. I'd say that's a number one innovation. I'd say number two is going to be the decisioning of that. So once all that information is in, you have all the information that you need to strategically make a decision. I was listening to a book this morning. I think it was called AI for Leaders or AI Leadership. The guy's name was Jeff. Well, it'll come to me. But one of the things he said you used to have to go away for a couple of days as an executive to really think through some of the strategy and get people together. Well, now you can pull up on chat and you can start putting in your strategic plan, and you're brainstorming with chat and they're pushing back on things. What do you think of this? And so I think that's a huge innovation on helping people make better, more strategic and thoughtful decisions when they're trying to go a particular route. And then I would say just the final one is, look, commercial real estate is an antiquated industry. It really is. It just hasn't been penetrated with innovation.
Mhm.
And I think what we want to do is we want to come in with a fresh pair of eyes and childlike wonder, and we want to come up with different ways. Like, why do people wait till the end to do loan documents with legal? Why do we do that up front? We should be having those discussions. And I think we need to start poking holes in the industry.
Yeah. So let me just probe on a couple of those things, because obviously the effect of AI on business is going to be fundamental. But efficiency, you that speed and low cost. How are you defining efficiency in your business?
Yeah, I think efficiency is speed. I think you can cut some of the fat, cut some of the time out of the way that people have to wait. So here's an example. You always have a bottleneck issue. So you have, two underwriters. Now you're lambasted with, 15 projects that are in the queue. Well, they're stuck. But if all of a sudden you have AI efficiency in there, those things can still be happening that they would necessarily need to do and have to have that file down. You can start cutting that fat down and make it more efficient, because now things are getting done that you would have to do normally with your two hands. So I think you're going to cut down the actual time. We built one ourselves, which is an algorithm that will actually go out, and we have our 15 points that we look at to rate a system. And so now it can literally go out and get that information within minutes and pull it back. Obviously, we have to verify it with a good, clean pair of eyes, but that just mundane administrative work that you would normally have to have a researcher do, it's done within seconds. And so I think that's going to cut down time. I think the other aspect you're going to do is you're going to naturally, as a byproduct, you're going to cut down cost. I'll give you an example. We just signed up a fund administrator for a fund. Well, for a young fund and a small fund, they usually cost $60,000 to $70,000. We have an AI fund administrator that's charging $10,000 a year. And I looked at him just like I'm looking at you, and I said, "How are you making any money?" And he said to me, "Dave, I make a 90% profit margin on the $10,000. And I thought, wow, because you can cut out the overhead fat.
Yeah.
So yeah, that's my thoughts.
That's great. Our long-term ambition is you cut out all bureaucracy, and you really, and you end up with 90% margins because the AI is doing the bureaucracy.
Yeah, 100%.
It's a possibility. So how long did it take you to build your AI due diligence agent?
We obviously were working with a group that is Waters Business Consulting. They do a great job. And I would say it took a couple of months or so for us to really dive in. There's some iterations that we're working through as well. But I think it's just one of many things that we want to do that we're just super excited about, because it just allows you to use your creative brain to go, why don't we try this? And I think you just always have to have that curiosity and wonder. And so that's how long it took us.
Yeah, that's great. There's other parts of technology in finance here, the whole Fintech world. A lot of it is blockchain and smart contracts, and some of it is things like syndication platforms and new ways to match lenders and borrowers. What do you think in that space? Is blockchain a backroom difference maker, or does AI just replace it?
It depends. I think, look, there's this huge world. We did a study on this, actually hired a third party to go out and do a study on this whole connecting the dots, the lender matching.
Mhm.
And although I think there's an element to that makes sense, part of the issue isn't the connecting, it's the nuances of understanding the right connections. Kind of like if I go onto eHarmony, and I remember I was dating at the time one time, and I got onto eHarmony, and I didn't click the right button, and I was getting connected with literally all over the country. Like, what's going on? And so the right things had to make adjustments to make the right connection, because nobody wants 50 lenders. It's just too much. You're like, I
Yeah.
want three.
Mhm.
We just don't have the bandwidth in our mind to go through that. So I do think that there is a place for blockchain, but quite frankly, with what's going on in AI, I think that could be a centralized thing to just say, we're going to use that as the framework to make decisions, and it'll be the backstop for how we do things. Part of that is everybody has to be willing to do the hard work of literally SOPing and mapping out their process and really understanding it and documenting it. And when you do that, then you can start getting really granular and doing some pretty amazing things. So that's
Mhm.
what we've done, and we will continue to do that ourselves.
Yeah. Let me ask you an economics question. One of the things you always think about in real estate is cycles, economic cycles, and
Mhm.
there are cycles at the macro level, with especially with interest rates in your world, but there's also cycles at the industry level. What we talked about, what's been happening to office real estate, office buildings, and so on, and just local cycles, comes and goes in local areas. How do you deal with cycles? What's your thinking about that?
Well, I have a couple of thoughts on cycles. One is they're going to happen. And I learned that when I first got into the business when I was young, and I didn't really understand cycles. And so I thought I was so smart, kind of like a half witted surfer that gets on a really good wave and says, "Oh my gosh, I'm so good." And then you get crushed by the wave and go, "Oh my gosh, what
Yeah,
just
this is
happened?"
hard.
So the first thing is just they're gonna happen. When, we don't know, but I think it's just you have to be prepared for the cycles when they do come. And then when they do, I actually just wrote a little bit of an article on this, is just using that as an opportunity to really refine what it is you're doing and probably adjust and iterate the direction you're trying to go, and recognize that even though there's a recession, and I heard this at an economic forum one time, they said, sometimes we just go, we're in a recession, we're not in a recession. I just don't think that's reality. I think it's a rolling recession. And I
Mhm.
loved that statement because I said, that's so spot on. Because one place could be doing great in an industry, and then you go into commercial real estate, like right now, since 2022, it's just getting crushed. I mean, people have interest rates that tripled, and you just can't have the same drive economically when that happens. So we're in a rolling recession, and it's an opportunity to foster relationships when you go into a recession. Number two is you have an opportunity to reflect and really ask yourself tough questions to say, should we be doing this, or should we be looking at a different direction? And I think the third thing is really just, having an anticipation and excitement to say, what do I need to learn in this time that's going to make it so that we can effectively be better in the way that we add value? Because it cuts out a lot of fat. Just the waves go out, and it's like,
Right.
well, who's wearing shorts? So that's my perspective.
Yeah, good. Well, it's good from recessions to imagining the future. That's what we talk about a lot in entrepreneurship, Dave. It's about imagining the future, not necessarily designing it.
Hmm.
You can get there eventually, but imagining what could
Yeah.
be the case in 5 or 10 years time. What's going to happen in your world? How will it look different in 5 years time?
Well, I think a few things. You look at the banking industry, and it's going through a bit of a revolution. I think some of it's just because of the rolling recession we're in, but I do think there's a bigger picture going on, where a bank used to be the thing you go to. And now you just realize they're shutting down, locations. And so the whole banking ecosystem, I think, is going to look very different in 5 years. I mean, you think about the amount of fintech, probably 15 plus thousand fintech companies right now that are competing with banks for deposits. And so I think that whole deposit system is going to get racked upside down and start to look at it from a whole new perspective of how does money flow and how do people actually get access to it. And I think you take that same tsunami with the $1 trillion that's coming down the pike from baby boomers, and you're going to see a very different outcome on how people are making decisions and how they're getting into projects. Like, for example, if you used to want to get into an alternative credit instrument, that was a country club issue. Okay. Now it's completely democratized. If I want to put 25 to $150, a person can go do that right now for an alternative investment. So that democratization is just completely cut down who has access to things right now. And that's creating a huge threat for those big institutions that were these ginormous groups that were the behemoths. And I think you're going to see those get crushed. Well, I shouldn't say crushed. That's going to be threatened. I think maybe in a good way where people can actually take their ideas and execute on them if they have the discipline and not be so constrained. And I think that's going to affect our industry dramatically in a positive way where we're going to actually have to be forced to think better and quicker and more effective in how we actually get deals done.
Yeah. Yeah, we like to think about that at the economy level too, all firms, not just in financial services. So I think of it now as there's this tiny sliver called the S&P 500, and it's all anybody talks about. There's a whole bunch of single employee entrepreneurships that have a large amount of the headcount, but there's this backbone of the economy, the 50 person to 1,000 person kind of business that we don't seem to think about much more. But the future of the ecosystem seems like, as you say, those big banks and the S&P 500 will somehow disperse, and the ecosystem will be much more of these backbone companies and network together. So is that a similar vision? Is that how you see financial services?
I think so. You've heard this statement all the time is, AI is not going to take your job, but the people that learn AI will. And I think there's some truth to that it doesn't replace you, but it creates the opportunity to put your Superman cape on. And I mean, I've even seen it myself with respect to, if I want to, I'll give you an example. Yesterday, we just hired somebody. I had to put an agenda together for him. He's coming in, for 2 days to do an onboarding. The agenda was done within literally less than minutes of just me saying, throw an agenda together. I put a couple things in there. It was done. That would have taken maybe an hour, maybe 45 minutes. And so to go from conceptualization in your mind to the execution and actionability of something is just very distinct now, where you can take a concept and you can put it into motion. Perfect example is Canva. You can go on a Canva and you got an idea, you start throwing it together, where you used to have to go through a whole marketing agency to do that.
Yeah.
So I think the same thing applies in commercial real estate, where now, again, there's more at risk because you're dealing with bigger dollars. But I do think that it's going to, rightly so, threaten in a positive way and force people to really say, we have to get better at how we come do this. Because when you go get an SBA loan, it's a nightmare. When you go get a bank loan, it's a nightmare. Yeah, it's just so much red tape. And my hope, my prayer is that that's going to start getting attacked with other people saying, let's just come up with an alternative product.
Yeah. So wouldn't that be great? Especially for the SBA.
Oh my gosh. Yeah. Not a fan.
So one difference in your world though, is that, I'm looking at all of these AI agents and using them, and you find out quickly that either the individual or the servers or the software or both is in China or India or somewhere else. That probably doesn't that's not the case in finance, is it? Or isn't it?
Not necessarily. I mean, the first thing you're always doing, and it's quite frankly in anything, is your job is to really put on your discernment hat and recognize, like, what are you really trying to get? And everybody's kind of thrown an AI hat on everything. And
Mhm.
so you just have to discern through and say, like, what's real, what's not, what actually has infrastructure or not. And so it'd be nice if there was a one size fits all. There's not. You're having to piecemeal everything together. It's like everybody says, well, I'm using this CRM. It's like every CRM has its own pros and cons. We use Zoho, and it's great, but there's still issues with it. So you're having to piecemeal things together to try to clunk, a process and figure out what fits and what doesn't in this jigsaw puzzle called process.
Yeah.
And so it's part of your job is to really, first of all, get clear. As our board always says, you better get really, really clear about who you're trying to hire. And the same thing goes on, like, what are you really trying to get? And that's part of your job as an executive is you got to get clear on what you need first, and then you can go find it. Strategy before technology, I guess.
Yeah. Yeah. So, Dave, you're also a podcaster
Yes.
behind the Capitol curtain. So,
Yeah.
why did you do that? And how is it helping you? And how's it helping the world? And tell us about it.
Yeah. Look, well, the first part was, why am I going to do a podcast? And I think we wanted to really say, let's try to hone in on something of pulling the curtain back. That's why we use behind the Capitol curtain to say what's going on behind these individuals that built a really amazing firm or a really great real estate development company. Let's get a little bit more into the weeds of what was the couple of things that you did that really shifted that and made that happen. And the design behind it is to add value to the user to say, okay, that's helpful. I can actually take that and then apply it because look, we've all been in college and theory's great. The Finance 101 textbook's great, but like, how do you apply that in real life? And so
Mhm.
we wanted the podcast to be a value proposition to people to say, not only are you going to hear these cool stories that are electrifying, but also to take that down to the application level and say, how can that apply to me today so that I can actually use it? And so, yeah, we're newer and we've launched, but we're excited about some of the guests that are coming on so that we can help the end user.
Good. Well, we'll put a link to that in our show notes, Dave, and we'll link to your website. Any other way you would like people to get in touch with you? And who would you like to get in touch with you?
Sure. Well, obviously we're raising money, so we're always looking for RIAs and family offices in order to have a conversation, see how we can be helpful to their investment criteria. And then obviously there's always the people that, need to borrow money and or raise capital. And so those are the people we're always looking for is seasoned, what I would call seasoned professionals that know their craft. And we really deal with the best of the best. And so, yeah, you can reach out there, or my number is 602-367-8795. And we'd love to connect and chat further.
Good. Well, we'll post all those links and we'll post your number. And it was great meeting you. We really appreciate it. I love the picture you paint of this future ecosystem that probably has more integrity capitals and fewer JP Morgans, or at least JP Morgan is smaller, and that may be a better world for all of us. I hope so.
I hope so as well, and just very thankful for you having me on the podcast today. This was a really fun time.
It's our pleasure. Thanks, Dave.
Thank you.
This has been another episode of the Value Creators Podcast. Thanks for listening. You can visit thevaluecreators.com for links and resources related to this episode. Check hunterhastings.com for more content on entrepreneurial business management based on value creation principles.